Welcome to this presentation of a very big reason why traders lose. This is the Specialist Trading Weekly Stock, E-mini, and Forex lesson. Hello everyone and welcome. My name is Stephen Primo. I am the president and founder of Specialist Trading. And in this week's lesson, I'm going to explain to you and show you in detail why most traders lose because of this one faulty area in their trading plan. But before we begin, as always, I ask that you please take a moment to view our disclaimer. I'm going to show you some past performance results, but please remember that we can in no way guarantee that any of these results will be repeated in the future. So please take a moment to view our disclaimer, and then we shall begin this week's stock, E-mini, and Forex lesson. Okay, as stated earlier, we're going to show you one of the reasons why most traders lose. This is a very big reason why most traders lose. And a lot of people may say, well, it's because I have a faulty trading plan. Usually I should be buying when I should be selling, or maybe I'm following the wrong market or the wrong time frame. Well, many times actually you are in sync with all of these things. You have a strategy that performs rather well. You are in sync with the market. You are trading the correct time frame that best suits your abilities. But the reason you may be losing is because you have an incorrect entry technique. Because most traders use incorrect entry techniques, and this really is one of the main reasons why they lose in particular trades. All right? What we want to stress, particularly with this particular webinar, is that you may be right on the direction of the market. In other words, your strategy, your signal that has been generated may be right, but you may still lose because of your entry. So that's why it's so important to have an entry that is fine-tuned, something that's going to get you in at a very high probability level for success. Let me show you what we mean here. Here's an example of a market. Doesn't matter whether it's stocks, E-mini, or the Forex markets. And as we see here, we are above the buy-sell line, the 50-period simple moving average. So we want to go long. And most traders would, beginner traders would say, well, I like to look at support and resistance. We have some type of resistance right here, as we see with that dashed line. So once we break out above that, that's where I should purchase and buy, because we've been taught that breakouts are the correct way to purchase any type of market. Well, as with most cases, what usually happens is you buy on that breakout and then look what happens. It goes straight down and you get stopped out. So at this point, you're probably thinking, well, my trading plan is faulty. I have the wrong plan. It doesn't work. I just purchased this, or went to this educator, or designed this strategy myself. It doesn't work. Or maybe I'm in the wrong time frame, or I'm trading the wrong market, because ultimately you got stopped out. But maybe you really weren't on the wrong side. Maybe you didn't have a bad strategy. It was just your entry technique, because look what eventually happened. Actually, the market did go up. So in actuality, you were right. It was just the fine-tuning of your entry. So how can we really get back on board to an entry technique that's going to give us these high probabilities for success and not get us in too early or too late and have us get stopped out? Well, here's the entry technique that we call the confirmation method. This is probably our second most important edge at Specialist Trading, and we're going to share it with you today. Now, let's say you have a strategy. It doesn't matter whether it's one of the ones we incorporate at Specialist Trading, or it could be something that you purchased from another educator, or perhaps you came up with this strategy yourself. When your strategy issues a buy signal, all right, the moment it issues a buy signal, rather than just simply buy at the market or place a limit order in there, here's what we want you to do. If a buy signal is generated, we only want you to buy once price trades one tick above the previous bar's high. Okay, that's it. It has to trade above the previous bar's high, whether you're looking at a 5-minute bar, a weekly bar, or a monthly bar. It does not matter. And as long as your signal is still in effect, in other words, as long as your strategy still says it's okay to buy whatever market you're trading, then you continue to track and remember to watch each and every bar and watch for it to trade one tick above the previous bar's high. All right. Let's say you get a sell signal. Let's say it's based on fundamental news, or let's say it's based off the full moon. It doesn't really matter. But if your strategy generates a sell signal, rather than sell at the market or place a limit or open order, do this instead. Once you have generated a sell signal, only sell once price trades one tick below the previous bar's low, and continue to track this as long as the signal is still in effect, or until you actually enter into the trade. Let me show you what I mean. Let's go back to that old example. We originally wanted to buy up here on this breakout. Once again, most traders, when they first start, think that breakouts are the way you should be trading. And there's nothing wrong with that, but you just need a little bit more assurance and some more tips and techniques to make sure that it's a correct and adequate breakout scenario. So you would have purchased here, and then ultimately you would have seen that the market went down and you would have gotten ultimately stopped out. Okay, rather than use that entry technique, let's just say that your strategy, you have faith in and you trust your strategy, but you want to use a different entry technique. You're only going to enter once price trades one tick above the previous bar's high. So as you see here, this is the bar you would have entered on where your strategy generated buy. Rather than just simply buy at the market or at this limit level, you're going to wait for it to trade one tick above the previous bar's high. And as you see here, you would have continued to track it all the way down. Now, if your strategy gave you an issue warning and said, well, it's no longer flashing buy, well then you ultimately you didn't lose any money, you didn't lose anything or sacrifice anything, so you're out of the trade, nothing ventured, nothing lost. But let's say it continues to say, yes, you should be long this particular market. Well, once again, you would continue just to track it all the way down until ultimately one of these bars traded one tick above the previous bar, as it did right here. That's your entry signal. So that's where you would have entered, and then look what happened. So you see, it was correct to go along this market. It was just that your entry wasn't based on sound guidelines, and you just kind of were a leaf at the mercy of the wind and just jumped in too early. So we want to make sure that we get confirmation that the market is telling us that it's going in the desired direction, and this is one of the best ways to get confirmation. All right, so let's look at some recent examples in stocks. Let's look at the stock Tiffany. As we see here, this was just this past month or so. Tiffany is above its 50-period simple moving average, and it's starting to go up. At this point, let's say your strategy, or maybe just your discretionary strategy, said, boy, this thing is going to take off. There's real no resistance. It's starting to move. I'm going to jump in because I don't want to miss this. So you jump in and you decide, I'm going to buy it because it's going to go straight up. You think there's another 5 or 6 points left in it. So this is where you buy, right? Because you just don't want to miss it. It's just getting ready to take off. Well, let's say you had purchased it there, roughly around the $66 level. Look what happens. In the next 3 days, it goes down. So you're automatically losing a couple of points in the next 3 days. Now, I can assure you that the majority of traders, after they got into a trade, the minute they see it go against them, most of them either pull the trigger or would have gotten stopped out. So this is what's great about this technique. This technique, avoids all those sleepless nights. It doesn't, guarantee it, but many times you will get in and not have to worry about getting in and sustaining a loss right off the bat. So rather than buy here and then see 3 days of downward movement, we want to apply our technique that we call the confirmation method. So once again, we would just wait for price to trade one tick above the previous bar's high. And as we see here on this third and last day, this is where we did trade above the previous bar's high. So you would have entered at 64.76 instead of roughly 66. You would have saved yourself a point and a quarter, and it was off to the races. You see, it was correct to purchase Tiffany. It was just your entry technique that was flawed. So rather than buy at the top and then stop yourself out or getting too frightened and start to second guess your strategy and exit at the market, it's better just to wait and see this technique unfold and then jump on board once you have confirmation. How about the E-mini markets? Well, we look at intraday trading in the E-mini. Here's an older chart of the E-mini on a 5-minute chart. As we see, we are below the buy-sell line, so we're only looking to go short. Okay, now once again, a lot of especially beginning traders like to look for support and resistance. Once they see these things broken, well, then they jump on board. So someone could have said, well, right here there's some support. We broke that, we traded through, so I'm going to sell. But rather than do that, you should wait, because the moment you would have sold, look what happened. It would have gone straight up about roughly about another 3 points. And I'm sure you probably would have gotten stopped out once we went above these old highs here. You probably would have gotten stopped out of the trade altogether. So in the next 5 or 10 minutes, you would have had a small amount of loss, and you would have been discouraged and said, well, this technique doesn't work, time to go back to the drawing board. But maybe your technique does work. Maybe you are on the right side of the market. You're trading the right time frame. It's just your entry technique that's flawed. So what we want to see is, once the signal is generated, rather than just jump in at the market or place a limit order, let's track this little movement to the upside. And we're only going to go short once price trades one tick below the previous bar's low. So nothing has happened yet until this bar. All right, so this is where you would have gone short the E-mini at 1393.75. And as we can see, in less than an hour, you've already generated a gain of 15 points had you stayed in the trade. So see, It was not wrong to be short the E-mini, it was just that your entry was flawed. And that's why most traders lose, is because they enter at the wrong time and then it goes against them. They stop themselves out and then they see the trade go in their direction. So use this technique, it'll really increase your odds for success. Now lastly, this can transfer over into any market. Let's look at the Forex markets. Let's look at an hourly chart of the euro yen. The euro yen's been going up. Now someone here, another thing that a lot of traders like to use is pattern recognition. Now looking at this right here, this is a nice flag pattern. Conventional wisdom says that once that pattern is broken out to the upside, this is where you want to buy, right? This is probably going to go the same distance it had in the flag pattern from here, the pennant, to the flag back up. Okay, so you want to jump on in and purchase once it breaks out right here. This is where your buy signal would be. So you jump on in and buy the euro yen on an hourly basis, and look what happens. Okay, look familiar. Once again, is it wrong to be long the euro yen? Well, at this point, had you purchased it, I'm sure you're saying, yeah, it is wrong to be. I've just lost nearly 100 pips, over $1,000. So this was wrong to be purchasing the euro yen. Maybe I'm in the wrong time frame, or the strategy is flawed. Well, maybe not. Maybe it's just your entry technique. Remember, rather than just simply buy at the market, we want to wait and see that price sells off on this little pullback here. And once price starts to sell off, that's when we start to track it and see that it trades 1 pip above the previous bar's high. Well, here's where it did trade 1 pip above the previous bar's high. So you would have purchased at 104.56, and then ultimately that's where the euro yen went up 170 points to your original level. So it was not, once again, wrong to be long the euro yen. It was your entry technique that was flawed. Okay, so let's review. Is this 100% guaranteed that it's always going to get you in at the right place at the right time? No, no technique is, but it's really going to substantially increase your odds for success, because the main purpose of using this technique is to jump on board a market that is already headed in your desired direction. Another way to sum that up is simply saying you're trading with the trend. You're going with the flow. So we want to jump on board a trade that's going in our direction. That's what we want to do. We don't want to try and pick a bottom or pick a top. That's really the lesson of this technique. Okay, so in the review here and in completion of this, remember, we're talking about an overlooked entry technique, something that's extremely important that we talked about today. Most people lose while they're trading because of their entry techniques. It's not because they have the wrong strategy or the wrong time frame or the wrong market. It's because they overlook their entry technique and they're using the wrong one. We really feel that this confirmation technique will help elevate your trading. But before you even apply it, you must learn all of our strategies here at Specialist Trading. And when we say learn, we don't only want you to watch the videos. We have a number of videos, and watch them as often as you like, or you can download the PDF files. Rather than that, though, or in addition to that, we want you to paper trade. Paper trade for as long as you see fit, because there's much more that you can learn while seeing the process unfold in real time. Remember, our edge here is consistency. From time to time, we will generate these home runs in our trade signals. But what we're really looking for are these nice singles, okay? Small little golden nuggets of trades that will be able to sustain us 10, 20, 30 years down the road. In conclusion, I ask you to take one last look at our disclaimer. I showed you a lot of performance results using this technique, but please remember that we can in no way guarantee that any of these results will be repeated in the future. Remember to watch the videos, remember to study them as often as possible, and then to paper trade. And thank you so much for joining us today. We'll see you next week with another stock, E-mini, and Forex lesson. Bye-bye.